this video, we will discuss 9 elements related to payment and acquisition cycle, starting from management accession until possible misstatement.
Figure illustrates a very basic supply chain with 3 entities, a producer with 1 supplier and 1 customer. 4 basic flows that connect the supply chain entities together are as follows. Flow of physical materials and services from suppliers to the end customer. Flow of cash from the customer to the raw materials supplier. Flow of information back and forth along the chain. And reverse flow of product returned.
What is acquisition and payment cycle? The acquisition of goods and services includes the acquisition of such things such as raw material, equipment, utilities, and repair and maintenance. In this topic, the main goal is to make sure that goods and services acquired along with any cash disbursement are presented fairly and comply with general accounting standards. Next, we move to activities involved in acquisition and payment cycle. The cycle is critical to our understanding of what internal controls become important, and as we consider business cycle, we need to understand it from the beginning point to the end point. So what we have is the payment and acquisition cycle as it relates to inventory and account payable. So if you notice, the very first place of this is the requisition for goods or services. A well-run organization, this requisition is coming from department level. The requisition is based upon the requirement for that specific department, but the department is not actually ordering the goods. The requisition is going to the purchase department. The purchasing department is responsible for ordering the good, for developing contract with vendors, for identifying pricing, appropriate vendor, and so forth. The purchasing department make a purchase requisition. This purchase requisition goes to the vendor and these goods actually ordered. When they are received, they will receive by the receiving department and we acknowledge the receipt and account for these goods and services. Essentially, what we mean that the receiving document will record and count the items that have been received and enter this into the computer system. The receipt of goods in MAS system is the starting point where we increase inventory and create an account payable. So the next step is approval for payment that come from the account payable department. The account payable department will receive an invoice from the vendor. They then match the invoice with what was received and purchased based upon quantity goods, based upon pricing, based on the three-way match. In fact, it does not match the account payable approved for payment. This approved goes to cash disbursement where the payment is made and the voucher that has been created by account payable then is cancelled. We move to related document in this cycle. As you can see, at the first column, there are 4 business functions where the first 3 are recording for acquisition goods and services, while the fourth one is for recording cash disbursement for payment to vendor. The first business function is processing purchase order, where it involves purchase requisition order form and purchase order. Purchase requisition order form means a document used to request goods and services, while for purchase order is a document used to order goods and services. Next, receiving goods and service. The related document involved is receiving report. Receiving report is a paper or electronic document prepared at the time goods are received. The third business function is recognizing liability. It involves vendor invoice, debit memo, and vendor statement documents. Vendor invoice is a document received from vendor and shows amount owed for an acquisition. Debit memo is a document received from vendor and it indicates a reduction in the amount owed value due to returned goods or an allowance granted. While vendor statement is a document prepared monthly by vendor and it indicates the beginning balance acquisition, return and allowance payment to vendor at ending balance. Finally, the last business function is processing and recording cash disbursement. The related documents are check or electronic payment, cash disbursement transaction file, and cash disbursement journal listing. Check is the document commonly used to pay for the acquisition, while cash disbursement transaction file is a computer-generated file that include all cash disbursement transaction processed by the account system for a period. And the last one is cash disbursement journal listing. Is a listing generated from the cash disbursement transaction file that include all transactions for any time period. Question 1. Management's assertion related to the cycle. Relevant financial statement assertion. When we are considering this, what we want to look at as to inventory as well as account payable relate to how this inventory balance match with this management assertion. Keep in mind that management assertions are the explicit or implied statement of management as they relate to inventory balance in financial statement. So the first one is inventory. Inventory consists 5 assertions which are occurrence, completeness, accuracy, cut-off, and classification. While account payable also consists 5 assertions which are existence, right and obligation, completeness, valuation and allocation, and presentation and disclosures. Question 2. Audit objective related to assertions. For inventory, the objective of assertion occurrence is the transaction recorded or disclosed actually happened and relate to the entity. For completeness, transactions should have been recorded and disclosed have not been omitted. Thirdly, accuracy. There have been no errors while preparing documents or in posting transaction ledger. Cut off. The transactions are recorded in the correct accounting period. And the last one is classification. The objective of classification is transaction recorded in the appropriate account. For account payable balance, the objective of the assertion for existence, asset and liability really do exist and there has been no overstatement. Right and obligations. The entity has a legal title or controls the right to an asset or has an obligation to repay a liability. For completeness, there has been no understatement of asset and liabilities. For valuation and allocation, the amounts at which asset, liabilities, and equity interests are valued, recorded, and disclosed are all appropriate. The last one is presentation and disclosures. The account payable balance is disclosed and presented fairly at appropriate amounts. Now I will proceed to the next question, which is the question 3 on what are the classes of transaction involved related to the assertion that Farah stated before. The acquisition and payment cycle is mainly comprised of 3 classes of transactions. The first class is acquisition of goods and services. For acquisition of goods and services, which is include the acquisition of things such as raw material, equipment, supply, utilities, and research and development. Once we acquire assets, we need to pay for them, so we will have cash disbursement. This cycle is mainly about incurring payables and paying off those payable with cash. And the last one is purchase returns and allowance and purchase discount. Sometimes we might have to return some of the items or the vendor might give us some types of allowances or we get purchase discount when we pay within the discount period. So we already know the three classes of transaction for the acquisition and payment cycle. Now we move to the question 4, which is on the relevant account or ledger related to the accession. Now, what are the accounts involved in this process? Here is a sample of account of the company. So we start with the buying raw material on credit. We are going to debit raw material purchases and credit the account payable. Once we pay the amount, we will debit account payable and credit the cash or bank. The term used is cash disbursement. The same concept apply when we acquire property, plant, and equipment, or even for prepaid expenses. When we return some items, we debit account payable and credit account purchases, returns, and allowance. Or when we pay within the discount period, we might get the discount, so we debit account payable and credit purchase discount. Also, when we acquire goods or services such as supplies, or when we pay our legal fees, auditing fees, and taxes, sometimes we will accrue them first. So, we need to debit administrative expenses since those are expense and credit account payable. When we make the payment, we should debit account payable and credit cash or bank. The same concept applies on selling expenses and when we acquire goods or services for manufacturing expenses.
Now we move on to the question 5. The proper internal control in place to secure the accession. First, we must understand the internal control. The auditor gains an understanding of internal control for the acquisition and payment cycle aspect of performance risk assessment procedure by studying the client projects, review internal control questions, and perform walkthrough tests for acquisition and cash disbursement transaction. Okay, first the completeness. The transaction-related audit objective. Exit acquisition transactions are recorded. The internal control procedure for completeness. Purchase requisition, purchase order, receipt report, and voucher are pre-numbered and accounted for. Next is accuracy. The recorded acquisition transactions are accurate. The internal control procedure approve price, terms and discount, internal verification of calculation and amount of supplier invoice, occurrence, recorded acquisition for goods and services received consistent with the best interest of the client. The internal control purchases are approved at the appropriate level. Internal verification of relevant documents such as purchase requisition, purchase order, supplier invoice, and goods received notes. Posting and summarization. Acquisition transactions are currently included in the account payables and inventory master file and are currently summarized. The internal control accounts payable master file contents are internally verified, and account payable master file or trial balance total are compared with general ledger. Classification. Acquisition transactions are correctly classified. An adequate chart of account is used, and account classification are internally verified. And lastly, timing. Acquisition transactions are recorded on the correct date. The procedure requires recording transaction as soon as possible after the goods and services have been received. They are internally verified. Question C. The test of control to test the effectiveness of the internal control. The test of control for the completeness. Account for the numerical sequence purchase order and good receipt note. Trace sample of good receipt note to the related supplier invoice and entries in the purchase journal. For the accuracy, the test of control. Exam proper approval for purchase requisition and purchase order. Exam indication of internal verification for recording purchase transaction. And exam file of batch total for initial of data control clip. Compare totals to summary report. And for the occurrence, the test of control. Exam proper approval for purchase requisition, purchase order, and good receipt note. Exam the indication of internal verification for this document. The test of control for the posting and summarization. Exam indication of internal verification and initial of general ledger accounts indicating comprehension. And for the classification, exam procedure manual, chart of accounts and internal verification for proper classification of purchase transaction. And lastly, timing, exam procedure manual, and also whether unrecorded vendors invoice exists, and indication of internal verification.
I will continue our presentation with question 7. The substantive test to achieve the audit objective. First of all, we will take a look about the objective of the substantive test. The substantive tests are an audit procedure that examines the financial statement and supporting documents to see if they contain errors. These tests are needed as evidence to support the assertion that the financial records of an entity are valid, complete, and accurate. How substantive tests can help to achieve audit objectives. Substantive tests include occurrence, completeness, accuracy, posting and summarization, classification, and timings. Occurrence is because substantive tests will make sure acquisition for goods or service received are recorded. Completeness is when the existing acquisition for goods and service also recorded. Accuracy is when all the acquisitions are correctly recorded. Posting and summarizations, all acquisitions are posted and summarized correctly in the master files. All acquisitions are correctly classified assets in assets and liabilities in liabilities file. Last, all acquisitions are recorded on the correct dates, not early and not late than the acquisition date. Types of substantive tests. There are three types of substantive tests. The first one is substantive test of transaction. It is focuses on testing an individual transaction by verifying them to supporting documentation. Second, substantive test of balance. Auditor focuses on substanting the ending balance of an account. And the last is analytical procedure, which is the most basic type. It is using comparisons and relationships to assess whether account balance appear reasonable. We move to the next question. Question 8. The audit evidence related to substantive tests. What is audit evidence? Audit evidence is all the information used by auditor to determine whether the information being audited is stated in accordance with the established criteria. What are the sources of audit evidence? There are two sources of audit evidence, which are auditor-originated evidence and evidence created by third parties or management or staff of the client. What is a type of audit evidence? There are 7 types of audit evidence. There are physical examination, confirmation, documentation, analytical procedures, inquiries, reperformance, and observation. Physical examination is involved the auditor inspecting or counting tangible assets, for example, counting cash on hand and examining inventory. However, provide little or no assurance to ownership objective. Confirmation is to verify information. Reliability depends on the form of confirmation, prior experience with the entity, the nature of the information being confirmed, and the intended respondent. For example, auditor can send a confirmation to a consignee to verify that a client's inventory has been consigned. There are 3 types of confirmation, which are positive confirmation is when respondent whether agree with the amount or information stated. Negative confirmation is when response only if the amount or information is incorrect. And last is blank confirmation. Documentation is inspection of documentary evidence, for example, ledgers, journals, payment vouchers, and invoice. Analytical procedures is consists of evaluation of financial information made by a study comparisons and relationship among both financial and non-financial data. For example, current year account receivable balance can be compared to the prior year balance after adjusting for any increase or decrease in sales and other economic factors. Inquiries is response obtained from clients, personnel, or management to questions raised by the auditor. For example, auditor may ask the chief account to explain on the discrepancy in amount of cash recorded against the physical cash exists in the business. Reperformance is rechecking sample of the computations and transfers of information made by client. For example, casting, cross-casting, reconciling ledgers to account balance, and testing posting from journals to ledgers. And the last one is observation. Observation is observe the performance of some activities. For example, segregation of duties between the person receiving payments from customers and person recording those payments in the account receivable ledger. Plan to observe stock count. Quality and adequacy of audit evidence. Determinant of persuasiveness of evidence by appropriateness or sufficiency. Appropriateness, relevance, whether the evidence relates to the specific audit objective being tested. Independence of provider, effectiveness of client's internal control, auditor's direct knowledge, qualification of individuals providing information, degree of objectivity, and timeliness. Timeliness is referred either to when it was accumulated or to the period covered by the audit. Sufficiency is measure of the quantity of audit evidence. They have to consider effectiveness of internal control, nature, audit risk and materiality, quality of evidence, and auditor's experience and knowledge of the business and its industry. The last question, which is question 9, possible misstatement. Before we go further, we need to know what is misstatement. In an audit, misstatement is the difference between actual financial statement items prepared by the client and those required by applicable accounting standards. In this case, misstatements arise from the transactions or balances of the company's accounts, which is not in accordance with applicable accounting standards. Three types of misstatements include factual misstatement, judgmental misstatements, and projected misstatements. Factual misstatement is a misstatement that occurs on a client's account balance or transaction of which there is no doubt. In general, supporting documents are usually available for auditors to review for factual misstatements. For example, wrong debit or a credit entry, incorrect amount of transaction or balance posted into the client's accounting system, wrong classification of accounts, and missing of disclosure. Judgmental misstatement is a misstatement that occurs in an audit due to differences between the client's judgment and auditor's judgment. These include the accounting estimate and accounting policies on judgmental areas, where auditors consider inappropriate. For example, include unreasonable depreciation rate and inappropriate revaluation amount of fixed asset. And the last one is projected misstatement. Are the auditor's best estimate of misstatements in population that arise from the misstatement that auditors have identified in audit samples and make a projection to the entire population which these samples were drawn from. Auditors usually make an evaluation of projected misstatements to consider whether further audit testing is appropriate.